Hi.
Good morning, everybody. My name is Neil Greenbaum. Welcome to the webinar, What We Know About the Corporate Transparency Act. I'd like to thank Riverside Filings for sponsoring this and Elliot Teitelbaum for his help. Today, the panel will consist of myself. I'm a transactional attorney. I have offices in Florida and New York. I'm joined today by Morty Book, who is a corporate lawyer for 25 years. He's a managing partner at Book Law, LLP. And I'm also joined today by Rafael Adler, who is an associate at Ulmer & Byrne in their Cleveland office. So here's our agenda for the day. We're going to be discussing the CTA, who has to file, what has to be filed, the exemptions to the filings, deadlines and penalties, the New York State LLC Transparency Act, which is also on the table, which I think will foreshadow many states joining the club here. And hopefully we'll have time for Q&A at the end. So I'm going to start with discussing the CTA. So the CTA was passed 3 years ago. It's basically going to try to stop people from, it's going to stop money laundering. It's going to stop people who are making fraudulent transfers. And how it's going to do that is by revealing who owns entities, corporations, LLCs. We'll get into it more. So it really, the primary purpose is to target shell companies, prevent money laundering and other illicit activities. It's regulated by FinCEN, which is part of the Treasury Department, and it takes effect on January 1st, 2024. Now, if you do violate and you fail to register, there are penalties involved, and we'll discuss that as well. So what does it say? The CTA requires all reporting companies to file a beneficial owners and company applicant information report. That's to be filed with FinCEN within 30 calendar days of when its formation has become effective, or if it was formed before January 1st, 2024, within 30 days, actually by January 1st, 2025. So I just wanted to discuss a few of the things. This is for collecting information that's going to be for national security purposes. And the information will be shared. It will not be open to the public, but it's going to be shared by FinCEN, and we'll go over who it's going to be shared with.
All right, so, I guess this is me.
We're now Morty, take over on who.
All right, who must file? The short answer is just about any entity that has been created with a filing with the Secretary of State or a similar kind of official in a state office. LLCs, corporations, limited partnership, just about any entity that most of us will be dealing with on a regular basis has to file. The person who's responsible to file for the report is the person A who prepared the report, and then B the person who filed the report. So if you if for example you're forming on behalf of a client, you prepare the paperwork. And then you hand it to Riverside Filings, which I recommend to file for you. Then they and you will both have to file that you are the filers, and you'll be responsible for it. Also, if an attorney has his paralegal file it, then the attorney and the paralegal both have to are both considered filers. Within the company, you have beneficial owners, and then you also have people with substantial control. Beneficial ownership is ownership that is directly or indirectly, you own 25% of the entity. This is a little complicated sometimes when you have when you have different kinds of structures, which creates questions which we don't necessarily have answers to. But I think it's fairly you could expect that it's fairly extensive. For example, the way that they measure 25% is not necessarily just straight equity. If the person owns debt that will allow him to take control of the company, or they have options, or they have contingent warrants, convertible warrants, everything gets measured. In a certain sense, that actually may benefit you because it'll keep you under the 25%, but that's how it gets measured. Also, if there's more than one class of stock, then if it's possible to create an equation where you're able to measure all the stock equally, then it would be 25% of that. However, if you can't, then it would be 25% of each class of stock. The people with substantial control are officers of any of the companies, president, vice president, not secretary or treasurer, but just about anybody who has the ability to direct the activities of the entity. There are exceptions to who must file. Minor children who own stock, their guardians, if their guardians file for them, then they are exempt. Trustees of a trust. If the trust has been formed and filed with the state, then you're going to have to the trustee will have to file as well. If you have a trust and you have granted the trust and you have the ability to revoke the trust, then you're in control of the trust and you have to file. If you are a beneficiary of the trust and you have the ability to withdraw the assets of the trust, again, it's not clear whether it's going to be all of it or just a part of it. It seems like it's all of it. Then you're going to have to file. If you have any, if you're somebody with a mortgage, then you on that trust where you're going to be able to get the money out of the trust, then again you will have to file. It's the question is whether something like preferred equity would be considered having a beneficial interest, and my guess is that it probably is, because it's they have the ability to take over the management. One of the complications in the area of substantial control is that you have to file within 30 days of changes. That may complicate matters if you replace the corporate vice president or the corporate president or one of the other senior officers, CEO, CFO, COO, etc. I think that
Morty, we have a question.
really covers it.
Morty, we have a question.
Yes.
Are not-for-profits or religious organizations obligated to file?
The answer, it's really one of the exceptions. It's Rachel's department, but I would say no, they do not. Not-for-profits do not have to. There are other important exclusions, but obviously I'll let Rachel address that in her presentation.
Okay, thank you. In terms of what must be filed, and if you're looking at the slide, we have it here. The company has to file certain information. The beneficial owners, which Morty discussed, have to file certain information. And if it's a new company that's created on or after January 1st, 2024, then a filer, which is called a company applicant, has to file certain information. Now, this is something when I first heard of as an attorney who forms entities for clients, I'm like, well, I don't want to be filing because I'm going to be a company applicant after January 1st, 2024. And the thing about the CTA is, like, if you remember those commercials about the Roach motels, the Roach check in, but they don't check out. Once your information is reported, it's there forever. It can't be taken away. So if you're a filer, now, obviously, if you're a company or beneficial owner, that's one thing. But if you're a filer and you don't want to have your information, which is your name, date of birth, address, and passport, driver's license number, if you don't want to have that on record with FinCEN, then you should use Riverside Filings or have someone else file, because you will be in the database and you're not leaving the database. Actually, it says it here in the third part. There is currently no way for company applicants to remove themselves from the database. and it's unclear as to whether the reporting obligation will be imposed on the company applicant or the entity itself. So we're going to have to find out. A lot of the things we've been discussing with regard to CTA are in the air because it hasn't come out yet. And I know there are many people against it, and I believe there might be a lawsuit pending where they don't, having to file information that's never had to be filed before. I mean, everyone who's in business or law knows that when you form entities, a lot of clients will say, well, I want to maintain anonymity. Well, that's going to be extremely difficult now that you're going to have a mandate that you're going to have to give information, and also New York State law, which I think Morty will discuss soon. The New York State, the difference with New York is that New York is public record. It's going to be that anybody can look at it. With regard to the CTA, the FinCEN is only going to share the information with a few people: federal agencies, state law enforcement agencies, Treasury Department, financial institutions, so long as the company has given clearance, government regulators of financial institutions, and certain foreign authorities who are requesting the information.
Neil, if I could jump in for a second.
Please.
The basic loophole to the government's intentions is that when you say to financial institutions, basically anybody who's doing real estate is going to have to, it's going to be reported to the lender on the matter, because obviously they know that they're going to be able to ask you to consent to give up that information. So again, most of our practice, most of my practice has been to do real estate transactions, and you find that you're very often advising the clients to form in Delaware, because Delaware does not require you to name who the owners are. That is basically out the window at this point for real estate.
Very interesting. Okay, we're going to talk now about some exemptions, and I'm going to have Rachel discuss them. And then I do have a few questions that I will ask in the middle because people are asking questions. Go ahead, Rachel.
Okay, so right now there's 23 exemptions that are listed in the act, and the general commonality between all of them is that these are companies that are otherwise regulated already. So they're security companies, insurance companies, accounting firms, if you're registered, and otherwise regulated. The two largest exceptions are large operating companies and inactive entities. So if you're a large operating company, that means you have 20 full-time employees and you filed an income tax of the previous year with more than $5 million in gross receipts. And these people don't have to file these beneficial ownership reports, because the idea is that the government already knows what's happening. You're big, you're otherwise on the radar. They're not worried that you're a shell company or money laundering. And then the next exemption is inactive entities. And these have to have been created before January 1, 2020, not engaged in active business, not owned by a foreign person, has not experienced any change in ownership in the preceding 12 months, has not received or sent funds greater than $1,000 in the preceding 12 months, and does not hold any assets. So it really needs to be an inactive company. This doesn't mean, a lot of times we curate holding companies or companies that don't do anything other than just hold assets, but because they're holding assets, they do not qualify as inactive. And
one of the questions that is, again, unclear, has to do with, let's say that you formed an LLC to do a deal last year, and nothing came of it, and the entity is, essentially just sitting there, and you're waiting. You decided not to dissolve it. You decided to wait until the state dissolves it for lack of doing your annual report. From what we know now, it appears that you would still have to file a report on that. And even if you dissolved it today, there's a good chance that you would have to file it. Now, the question is, if with an LLC, just as I described, if it doesn't have a if it doesn't have an EIN yet, then there's probably no way for the government to know who to send a notice to. But, you know, obviously I wouldn't take chances.
So I have a few questions. Rachel, I'll pose them to you because you're dealing with exemptions. Of course, Morty, jump in. Are foundations required to file?
They are formed by filing with the Secretary of State, and they don't fall within, they're not a 501c3, then yes, that would.
Okay. Do hard money lenders who take a pledge of LLC interests and as such are contingent beneficiaries, and also they have substantial control over what the LLC may or may not do, the SP verbiage required by the lender, are they required to file?
So that's, right now it's clear that if your only interest in the company is as a creditor, then you do not need to file your information. There's some unclarity as to whether you count as having substantial control, because with certain like veto rights, the regulations provided examples of what substantial control is, and that includes things like, I'm sorry, like incurring debt or preventing the sale or release of something, like certain things that a lot of
I think
minority holder rights. And
I think it's a little complicated based on the fact pattern because of the fact that that they do have so much control. But it really depends on ultimately how the government decides to define money services businesses. Money services businesses, no matter what the control would be, would probably be exempt. But again, the fact that they have such a tight hold on the security, complicates matters. But I would say that based on what we know now, probably not.
Okay, here's another one. If you use a PEO for your employees instead of being the direct employer, would you qualify for the larger operating company, assuming you have more than 20 employees and 5 million gross receipts on a prior return?
Well, this affords me the opportunity to give a big plug to Book Law LLP. We're an employment law firm and we're pro-business. We're a pro-business employment law firm, and ultimately, once the CTA becomes a little more clear on many of the regulations that have not yet been published, we should be able to help you with the answer to that. But until then, nobody knows. I would
Somebody
guess,
also
yes.
asked,
I would guess yes, because
Sorry,
they are. If you'd be a public company, you'd have to reveal that. So I would guess that that's probably the case. But again, we don't know at this point. I really regret the fact that we have to keep saying I don't know, but it is a very, despite the fact that the word transparency is in the name, it's still very, very murky as to what will be required. And hopefully the lawsuits that are out there will succeed, or at least put it on hold for a while, so that at least it'll give FinSec the opportunity to get their act together and really tell us what's going on.
So Morty, because you said the word transparency, I've been told that whoever will be applying for CLE credits for this webinar, they'll be asked for a word, and that word is transparency. Someone had asked also, on commercial loans, if lenders have to approve any major leases, would that be deemed substantial control?
well, that
Again, lenders are exempt. So, and the reason that they're exempt is not that the government doesn't want to know about them. It's because they've already provided their information to the government. So, I would say that most probably the LLC that is filing, or the corporation, or whatever entity you're using, for the deal, I mean, I would put down the lender as someone with substantial control and let them fight it, but they don't have to file themselves.
Okay. Rachel, you continue? I know we interrupted you for any questions, but if you have more to say on exemptions.
No, I think we,
Okay, somebody had also asked about pre-existing entities, whether they have to register, and the answer is yes. In fact, FinCEN thinks that there'll be 32.5 million entities required to file initially that would fall into the category of what is a reporting company, and then annually about 5 million. So I mean, it's going to be, in a way, it could be a mess. It just seems like a lot for a new law, but we'll see what happens.
The
Okay.
the other thing before you go off this slide
Sure.
is number 22, the subsidiaries of certain exempt entities. There also is an exemption for subsidiaries of entities that themselves have filed. So that if you're wholly owned by a reporting company, you would not necessarily have to do that twice.
Interesting. Okay, thank you. Okay, let's go to the next slide. Deadlines and penalties. Do you want to discuss it more, or should I discuss it? I don't
You
remember
go
where we went. Okay, so as we said, if you're an existing entity, then you have until January 1st, 2025 to report. If you're a new entity, which is filed after January 1st, 2024, you have 30 days from formation. So, and it's a one-time filing, but if there are any changes or any updates, you have 30 days to take care of that. What if you don't file? Because I'm sure that's the question that we're all going to get. What if I don't file? So there are plenty of penalties. There's $500 per day civil penalty, the $10,000 fine or 2-year imprisonment. It's going to be very interesting to see what they do with that. And there is a 90-day safe harbor. So a person is considered to be liable if the person caused the failure to report the complete or updated BOI or is a senior officer at the time of failure. So I'm stressing to all my clients who have entities that are going to be deemed reporting company, and most of my clients are going to be deemed reporting companies, that they should take care of their filing when necessary, depending whether it's an existing entity or a new entity. And I would suggest that everyone just put it in writing, like send out an email, something like, because this will come back with somebody said, you didn't tell me. I know it's going to happen. So, okay, I already discussed this before, but who will have access to the information? So the information is not public. It's not somebody's going to be able to go and look at what was reported. It's only going to be given out by FinCEN to these 6 types of entities. But the New York law, which Morty will discuss, is going to be a public record. You're going to be actually, I believe you're going to be able to go online and you'll be able to see who are the beneficial owners of a company, which is going to be very interesting. Morty, New York State.
The New York State LLC Transparency Act is very, very similar to the FinCEN Act, to the Federal Act. There are important differences. One is it's only LLCs in New York at this point, not corporations, not limited partnerships. That's number one. Number two, as Neil said, the complicating factor is that the names and business address will be publicly available. Again, that is going to be required not only of New York LLCs, but any LLC that is qualified to do business in New York.
Any clue why it's only LLCs?
No.
Because FinCEN has a much broader scope.
Yeah.
Interesting.
The exemptions, it's interesting. In the CTA, you have to wait basically until FinCEN knocks on your door and says, "Where's my report?" In New York, you have to have you actually will have to file a statement from the LLC that says that they are exempt because of, and then cite the part of the CTA that exempts them. The thing that's actually easier in the New York Act is that if you don't file, the penalty is much smaller, at least initially. It's that they're they're not going to do anything for 2 years, and in that 2 years, you'll be delinquent, but you won't have to be penalized. But after the 2 years, if you still haven't paid, you're going to you're gonna be discontinued, dissolved as an entity if you don't file. If you do file, then you'll have to file plus a penalty of $250.
Is it a one-time civil penalty? $250?
Yep,
It's better than $500 a day.
slightly, yeah. And then, well, the truth is that you can't. I mean, it would be very strange for somebody to file with CTA but not file with New York at the same time. And if they don't, you're going to have if you don't file in New York, you probably didn't file with the CTA either, with FinCEN either, and so you're going to end up, having the worst of the punishments regardless, and then after 2 years, you'll get dissolved also. The final difference is that the CTA requires you to file any changes within 30 days of the change. New York does not require that unless there's an amendment to their articles of organization that were filed with New York. Of course, New York does not require articles of organization to be filed for LLCs. So I don't think that is a very scary consideration.
Right. It doesn't have as much bite as the FinCEN.
Yeah.
Though to me, it's worse that it's public. That's a big difference.
Of course. But you have to imagine that the FinCEN is obviously is going to be tied to the IRS, and so they're between the IRS and your lenders. Most of the people that you're creating complicated structures to prevent are no longer going to have that benefit.
Right. Just a point. 2 people ask if copies of materials will be available and if there will be perhaps a replay, a recording of this. So yeah, if you just request it from Riverside Filings, I think they can handle that for you. A couple more questions came in.
Correct. 1 second, Neil. LD title.
So
I'm here. Everyone that is asking, yes, please request from me. We're going to try to send them to everyone that attended, but definitely if you ask, you'll definitely get both the recording you could get as well as copies of the slides. Just to stick on this slide just for one more second, on the bottom it does say other states are doing their own, just like New York. So right now, a lot of people, like Neil mentioned earlier, Delaware is very common because people want to be anonymous. And I know that Delaware themselves are also considering doing such a thing. I'm finding other states, like I think it was Illinois, started asking for business owner information, which they didn't until now. And New York happens to be also a state that never asked for it until now. So a lot of states that used to be anonymous are now not going to be that way if they start adapting this. So it will become public in that sense.
Yeah, it's going to be the wave of the future, I'm sure. After New York does it, everyone's going to fall into place. Here's a few more questions that came in. Does FinCEN have an enforcement arm? Would they bring the cause of action against the entity for failure to comply? So FinCEN, FinCEN's part of the Department of Treasury. There are Treasury agents. I know that when people get in trouble. So I believe that that's their enforcement. I'm not sure about cause of action. Anybody? Rachel and Morty?
Oh, generally speaking, FinCEN, similar to the SEC, does not have a criminal investigative arm. So but as you say, they are part of the Treasury Department, and there are criminal penalties. So ultimately, if they will have to bring an action somewhere.
Would it be? I'm curious. I don't know if we know this answer, but they would bring it against the reporting companies, but would the beneficial owners be on the hook as well?
Yeah.
Which is fascinating because the whole point that people are creating corporations and LLCs is to avoid personal liability and to separate the personal assets. But
yeah, but there are certain areas where you get, just even as a matter of routine, you get past the corporate veil. For example, and here's another plug for Book Law. Wage and
There you
hour
go.
claims-
Book
wage and
law.
hour claims go up to the owners. There's, you can't cheat your employees, which is a good thing.
True. Will the federal government be noticing all existing entities of the requirement to file? I don't know, but I would say there's no way that 32.5 million entities are going to get noticed in any way by any federal government arm. Rachel, anything? What do you think?
No, I think right now their talking point is that their purpose is education and not to penalize people for not being in compliance, but again, a lot of things are still unknown.
Right. Are there any provisions in place to prevent these filings from being discoverable in litigation and or subject to subpoena? Morty, how about you on that one?
Well, it's the thing that I've been looking at over and over and over again, because that's the thing that I probably fear the most. It does not look like it, but if there's a compelling reason that gets presented to FinCEN, I think that they might, but I mean it's basically like IRS records. You can't go to the IRS and just ask for for information without the person's consent. So I'm guessing probably not, but it is something that I've been particularly concerned about, and I haven't really found much on it.
Right. So this is really not a question. I think it's just a statement. It's not worth filing in New York and letting everyone know who the members are. Better off paying $250 to keep the anonymity.
Well, yeah, until 2 years pass and you're out of business.
Right, because they're going to dissolve your entity. Right. That's the and I'm sure if people aren't filing, they're going to come up with something else. Maybe they'll more than $250 every 2 years, whatever it is.
Look, they can always amend
on that action, just to be clear, right now in New York, like I said, it's every 2 years because of the biennial, which is due in New York. Right now, New York is not actually dissolving entities for not filing biennials, which other states are. So at any time you could go file them, and it's not in the biennial report. It's not clear yet if this new New York State LLC Transparency Act is going to be part of the biennial or it's going to be a separate filing. It could be you could still do the biennial and just not do this. Not clear yet.
Interesting. Another question. What other states are considering this type of legislation? So we discussed that Delaware and Illinois, and I'm sure like after New York and Delaware, a lot of states are going to. And the second part is, sorry, again.
I would put California probably at the top of the list.
All right, California, right. What about what's the states that pride themselves on anonymity? That's where they're selling entities, like Nevada, Mexico, whatever.
Wyoming and Delaware, Nevada. Ellie, I don't know if you know more than that. I know those three.
Well, like I said, New York, you never had to.
Right, it's true.
People don't count it, but it's true. You never had to.
Right. So here's the second one. Is there a percentage ownership threshold required to be considered a beneficial owner under either New York or the federal side? I think we said 25% on the federal.
25%, yeah.
How about New York? Is there anything there?
And New York State will basically staple a copy of the CTA to their legislation. My guess is that New York will probably amend the law at some point and take more than the LLCs, and who knows what else will come in, with that. If they find that people aren't filing, then they may take measures to put more teeth into the penalties.
Okay, so someone here actually mentioned Morty. Morty tried to compare it. I guess he means CTA to the other IRS filings, but there's a specific provision in the statutes that shields the IRS from having to provide tax filings, etc. My question was if such a provision exists for this too.
I'll defer to Rachel, but I don't think I haven't seen any.
Yeah, I haven't either, but right now it's very clear as to who can access this information, and civil suits are not like there's no process in which they can access that. If it's the government filing, then yes, they can, but it's limited as to who can access.
The intent of the law is to deter money laundering and create some accountability. It's not really in the government's interest to help private litigants, but you know, again, it doesn't say, and the fact that the IRS has a specific publishing about that, I'm not a tax attorney, so I defer to your knowledge of that.
Right, and like we mentioned, this is going to be a lot of wait and see to see how things are going to be enforced and how things are going to go. I mean, when I see that number, 32.5 million entities, or have to file, it's just, I don't know. It seems like plenty will not, but let's see what happens. Let's see.
Well,
The earlier
if I
slide
would have
regarding
to-
beneficial. I'm sorry, go ahead.
Go ahead, Neil. Go ahead. I'll summarize
Sure.
later.
Okay, the earlier slide regarding beneficial owners noted an exemption for an individual employee. Can you please explain this exemption again? Rachel, that would be for you.
So as an employee of a company, you are not considered to be a beneficial owner.
Unless you're an owner and an employee, I assume.
Or you're an officer employee.
Right.
Okay.
But let me just say this:
Sure.
you can't get around it by not naming the person president of the company, but the person is doing the job of the president. Then just being an employee wouldn't help them. It's really aimed at people who are controlling the entities, people who are directing the day-to-day activities and the extraordinary activities, sale of the company and so on.
Right. And here again are the exemptions. And as Elliot said before, if you ask for a copy of the PowerPoint, you can get that.
Someone did ask about the large operating companies. I replied privately, but basically you have to meet both those criteria. You have to have 20 or more employees and have 5 million in gross receipts or sales.
There's a third requirement, which is that you have to actually have an American business address, and that can't be a residential address, and it can't be a shared address. It's got to be just the company.
Okay. Here's a couple.
And I think Rachel went through all the inactive entity requirements, but all the other exemptions are basically entities that are monitored in other ways, like banks and SEC entities and nonprofits, like someone asked. So the main two exceptions are the two ones on the right. For regular businesses are the large companies or inactive companies where you have to not be active for 5 years. Sorry.
Okay, here. I think that an S Corp is the option because corps aren't required to file. You get the benefits of an LLC. Are S Corps an exempt? I don't know.
No.
No,
So
all
you-
entity types have to file. S corp
S
is
corp-
really a designation.
It's a
Just to be
tax
clear, S
designation.
corp
It's
is
not a
a tax
right.
designation.
I tell that to
So
people. all the
you're
time.
either an LLC or a corporation, and corporations do have to file, unless he means New York. In New York, you do not. New York is only LLCs.
Okay, Morty, I think this might be for you. Can you elaborate on how convertible stock, stock options, and preferred stock with a liquidation preference would be evaluated for purposes of the 25%? What about super voting stock?
So super voting stock would not necessarily fall under the 25%. If you have the right to control, even if you have only 1%, you'd have to file. So that would help. If you're the way that I understand it is that they treat all options as being exercised, and then they count 25% from that. So that actually may help some people. Basically by giving options to somebody, it dilutes you down under 25%. And as long as you're not the person who has substantial control, I think that you'd probably benefit from that.
Okay. How would this apply to cooperatives and co-ops? Or maybe condos and co-ops. This says cooperatives and co-ops, but maybe both. Anybody?
I don't know.
Rachel, is there an exemption for that? Do we know?
Yeah.
But isn't a cooperative a corporation? A co-op?
If
I
it's,
believe they are corporations, yes.
yeah, they do file with the state, so they would qualify even.
I think
It's
so.
it's not just LLCs, corporations, limited partnerships, it's anybody who files with the state. So, I would think that you'd have to, question is, who owns it? Who owns 25%?
Interesting. Following up, Morty, on what you mentioned before, someone asked, even if the options are far out of the money?
Again, I don't see any exclusion of that.
Right. It's not,
If they're expired, then yeah, but out of the money, it's not. It's not FinCEN's business whether you're going to make a profit or not.
right, exactly. It's not a money maker. They're right, exactly. Okay. Well, Elliot, do you want to speak about how Riverside?
Hold on. If I could, I'd just like to add one more thing
Please.
especially for the lawyers who are listening. When you are creating LLC agreements or other operating agreements, or if you are or if you're you have an offering memorandum, I would recommend that you put in a few things. First of all, that each of the shareholders, members, etc., will warrant that they are going to agree to the filing and will file. Also, a representation that they will continue to file and to comply with the CTA and frankly any other federal or state requirements that will require filing. And then a third thing is, especially in LLCs, there's almost always a clause that provides that the members do not get affected by the actions of other members. In this case, I would put it at least try to put an indemnification clause in there, where all the members will indemnify the LLC if they give false information to the in the filing, or that they don't, and the LLC gets whacked for it.
Those are great points. Great points. So here's another one. How would this apply to employee cooperatives like Chicago Glass Company taken over by the employees when the company was seeking to move the company overseas?
I want to just say we're going a lot to the 25% rule, but I think Rachel had the other qualifications as in terms of who's responsible is also the CEO, the CFO, and the people that are responsible for the company, even if you do not have actual 25% ownership. So this is not a loophole. The fact that you don't have people that have 25% ownership, it just passes on to somebody else who has
There's
direct
always a
control.
beneficial owner or a responsible party, even if there's no 25%.
I would assume if you're the it doesn't say, but I would assume if you're the managing member of the LLC, even if it has a business that has a president, CEO, and the managing member does not have the day-to-day contact with them, that they would probably have to file as well.
How can Riverside filings help? Elliot, that would be you.
Okay, yeah. So I would say the main thing, and that's why we're doing this both free webinar, and hopefully we'll have more updates as we get closer to 2024. The main thing is, like you said, this 3.2 million entities that will have to file, existing entities, like someone asked earlier, and everyone needs to get it done over the next year. And we are here to both tell people, keep people updated on the law. As soon as it goes live, we'll be able to help you in telling you how you could file if you want, and we'll also hopefully be able to help you file as well as a filing company, and that applies to the business owners of existing businesses. And then, like you mentioned earlier, attorneys and accountants and anyone filing LLCs has to know on their end that if you want to continue doing that, there is a specific filing for filing companies that you also have to be included, not just the owners. So be ready to give your information to the FinCEN, get yourself a FinCEN account, or if you don't want to, find a company that will do that for you. And hopefully we'll be able to do that as well.
Right. So I have a question before we go into the summary. Indemnification, this is based on what Morty said about operating agreements. Indemnification provisions in operating agreements are a good idea, but everyone should be mindful that there cannot be indemnification for criminal culpability. And if this is going to entail criminal provisions, then senior officers, etc., should be very wary.
Good point.
Good point. Just to wait, another question just came in. Speaking to co-op and condo boards, since they can change yearly, what would be the reporting requirement then? Most co-op shareholders do not control 25% with exclusion of sponsors.
Well,
Would a management company have to file with someone?
well, from a strict reading, anytime there's a change, you have a new person at the top, president, CEO, COO, CFO, general counsel,
Board members?
board members, someone who has the power to remove board members. You change one of them, even if they don't actually have that power, but they have that title, then you're going to have to file within 30 days. So if there's a co-op board that filed with the state, and the president and vice president don't actually do anything, but just sit there as figureheads and run meetings. I'm sorry, but they probably would have, from a strict reading, they would probably have to file within 30 days.
Interesting.
I will say someone messaged me privately also that the co-ops can be filed with the county. So not too many co-ops myself, but if they're filed with the county, then
Elliot, I don't know about anybody else, but I can't hear what you're saying.
I think he said that co-ops are filed with the county.
But
So-
it has to be the state. If it's not the state, then it would appear you don't have to worry about it.
Right, but I think I always thought co-ops had to be filed with the Attorney General, which would be on the state level, but okay. So anyway, in summary, well, more questions that come in, but let me just do the summary and then we'll answer whatever questions come in. So January 1st, 2024, all entities will need to file under the CTA with FinCEN. There's penalties for not doing so. That's for existing entities, you'll have until January 1st, 2025. And we do have unanswered questions, which we'll do in a second. We'll just answer this one. Co-ops filed with New York State Department of State. Right, okay. And here's some questions that we had that we came up with, we cannot answer at this point, and they're going to be more than this. So just remember, if you have an entity that would be deemed a reporting company, and most entities are reporting companies of corporations and LLCs, then you're going to have filing requirements with this. In New York, you're going to have filing requirements, probably in other states as well. And this is the wave of the future as far as that's what I see at this point. Anybody have any closing remarks? Good.
I would just say that anybody who has questions on how it impacts employees, please feel free to call the Book Law Firm.
There you go.
And anybody who will
You
have
should be plugging yourself.
and anybody who has continuing questions about the CTA as it goes through should please feel free to call Elmer and Byrne and of course Neil and
Riverside.
And Riverside, of course, but they don't give legal advice. But thank you, Elliot and Riverside, who have been really phenomenal to me all these years in your department and in your other departments.
Thanks. Some questions came in, Elliot, about CLE credit. So if you could just, I guess, send something out to people, or tell us. Can't hear you. You're muted.
oh, sorry about that. Okay, Neil, you mentioned earlier if anyone needs CLE credits, there's going to be a form that's going to be sent out to everyone. Neil mentioned the word earlier, I think it was transparency, and you'll need that when you fill out the form, and we'll get it over to you. The only other thing once we're on this the questions tab, someone asked about if somebody is challenging, and it is here the National Small Business Association is technically challenging it, but I haven't seen enough traction with that to say that it will be repealed before it goes into effect.
Okay, somebody else came Okay, great.
Oh,
Okay, thank you, everybody.
Yes, thank you everyone for
Okay,
joining.
just
and feel
from
free
the
to reach out if you
Riverside,
have any
from the
questions.
Riverside team. One second, just a quick note to all the attorneys who are getting CLEs from the Riverside team. It does take a little bit of time. So I know some of you are very impatient to get your CLEs, but and we get tons of emails from you. We're going to send it to you. Just give us a little bit of time to handle it, okay? Thank you.
Thank you, Aaron. Thank you, everybody.
Thank you.
Everybody
Thank
here.
you very much. Have a great day.
Thank you very much. Thank you, Neil. Thank you, Morty. Thank you, Rachel.
Thank you.
I keep saying Rachel and Rachel.